What if the money you think is safe is already moving inside a conflict you never agreed to join? Not a war you can see on news headlines with soldiers or explosions, but a silent financial confrontation between the two most powerful economies on Earth, China and the United States. And the unsettling part is this: you are already inside it. Over $130 trillion in global financial assets are indirectly shaped by the stability of this relationship. That includes pensions, retirement funds, stock markets, and even the banking system that holds everyday savings. In other words, this is not a distant geopolitical issue. It is a structure that quietly supports the value of money itself. So when you look at markets and see stability, green charts, slow growth, controlled volatility, you are not seeing safety. You are seeing dependence disguised as stability, because modern globalization did something extraordinary. It connected the entire world into one massive economic machine. For decades, China became the production engine of the world, manufacturing everything from electronics to industrial goods at scale, while the United States became the consumption and financial engine, driving demand, innovation, and capital flows. This system was incredibly efficient. It lowered costs, increased corporate profits, and helped control inflation across global economies. Inflation, in simple terms, is what happens when the cost of goods rises faster than income, reducing purchasing power. Globalization suppressed it by moving production to the cheapest and most efficient regions on Earth. But efficiency always hides a cost. And in this case, the cost was dependency. Trade between China and the United States once exceeded $690 billion annually, creating the illusion of economic harmony. It looked like two giants building prosperity together, but in reality, it was a fragile balance, where each side became deeply dependent on the other's system continuing to function without interruption. And then came the first crack. In 2018, tariffs began to reshape global trade. Suddenly, hundreds of billions of dollars in goods were caught inside political tension. What once flowed freely across borders now became subject to restrictions, negotiations, and uncertainty. Companies like Apple didn't just face higher costs. They faced a deeper question: what happens if the system that built global manufacturing stops being reliable? And that question changed everything. Because markets don't react to what is happening now, they react to what might happen next. Stock prices are built on expectations of future cash flows, discounted into the present. When uncertainty rises, that discount becomes stronger, and valuations fall, even if real profits haven't changed yet. That is why billions can disappear from markets in hours, without factories closing or products stopping. Because what moves first is not reality, it is confidence. And confidence is the invisible foundation of all modern finance. But beneath this trade tension lies something even more powerful: financial interdependence. China has historically held large amounts of US Treasury bonds, government debt that finances American spending. At the same time, the US dollar remains the dominant global reserve currency, representing around 58% of global reserves. This creates a strange structure of power. If China sells too aggressively, it risks damaging the value of its own holdings. If the US weakens its financial credibility, it risks destabilizing the entire global system. Neither side can move without consequences. This is not traditional strength, it is mutual constraint. And while this financial balance continues, both economies are carrying another hidden pressure: debt. The United States now holds over $34 trillion in national debt, meaning a large portion of future government revenue is already committed to paying past borrowing. As interest rates rise, more money goes towards servicing debt instead of growth. China, on the other hand, faces structural risks tied to its property sector and local government financing systems, where much of past growth was fueled by continuous borrowing and asset expansion. In both cases, the system does not depend on immediate collapse. It depends on continuous confidence, because once confidence breaks, refinancing becomes harder, credit tightens, and entire economies begin to slow simultaneously. And just when you think this is only about money, the battlefield shifts again to something even more critical: technology, semiconductors, tiny chips smaller than a fingernail that power everything in the modern world: smartphones, artificial intelligence, military systems, financial networks, and even global communication infrastructure. And here is the critical point. Taiwan produces over 60% of the world's most advanced chips. This means the future of technology is not just about innovation. It is about control over production capacity itself. That is why export restrictions, chip bans, and AI competition have become central to the US-China rivalry. Because whoever controls advanced computing power controls the speed of intelligence, automation, and economic growth itself. In simple terms, chips are the new oil. But unlike oil, they don't just power machines. They power decision-making systems. And here is where the story becomes personal again. Because most people believe they are diversified. They own index funds, retirement accounts, global stocks, thinking risk is spread across thousands of companies. But what they don't see is that many of those companies are tied to the same global system. So when tensions rise between China and the US, earnings expectations shift across entire sectors at once. And because markets price the future, not the present, everything adjusts instantly. This is why during global shocks, diversification often fails. Because correlation increases, meaning assets that once moved independently begin moving together, especially downward. And the most dangerous part, most people don't act, not because they are unaware, but because the human mind assumes stability will continue. It adapts to slow change, ignores gradual risk, and waits for confirmation that never comes early enough. Now imagine what happens if this tension escalates further. Supply chains fragment into separate systems. Production becomes more expensive and less efficient. Inflation rises not because people are spending more, but because the world is producing less efficiently. Technology slows due to restrictions, and global trade splits into competing economic blocks. Markets will not wait for certainty. They move on probability, and when probability shifts, prices adjust instantly. So the real question is no longer whether this conflict exists. It already does. The real question is whether you understand what it means for your future. Because in this new financial era, survival is not about predicting the next crash. It is about recognizing that the system you depended on is already changing beneath your feet. And now I want to leave you with a simple question. Are you financially positioned for the world you were told exists, or the world that is actually forming right now?